All right, so Starbucks just dropped their latest quarterly results. And for any investor watching, it's a real tale of two cities. We're seeing clear signs of life after a long, long time. But man, they are paying a steep price for it. Okay, let's break down what these numbers really mean and whether this is the start of a huge comeback or just a gamble that's gotten way too expensive. And this right here, this lays out the core tension perfectly. On one side, global sales are finally growing again, up 1%. But on the other, earnings per share have absolutely plummeted by a shocking 85%. So how is it even possible for these two opposite realities to exist in the same quarter? That is the key question we are going to unpack. Now, to really get why that tiny 1% is such a big deal, you have to put it in context. We're talking 7 quarters. That's almost 2 full years of stagnant or declining sales. So this little positive number is basically the first light at the end of a very long tunnel. And it's the whole reason they launched this massive and very costly turnaround strategy. So how'd they do it? How did they manage to take this first big step? Let's take a look at the strategy that the company says is finally starting to pay off. Now, what's so interesting here is that we're hearing directly from the CEO, Lakshman Narasimhan. He's not framing these results as some lucky break. No, he's presenting them as concrete proof that his plan, called Back to Starbucks, is actually working. That's a pretty bold statement of confidence, especially when you're also reporting some really tough profit numbers. And here's that plan, broken down into its 3 pillars. See, this isn't just about cutting costs. First, it's about making the in-store experience better. More staff, better service. Second, and this is key to understanding the costs, they're optimizing their store portfolio. That's a nice way of saying they're closing hundreds of underperforming locations. And third, they want to get back to being an innovator, both with their menu and their marketing. This is a complete overhaul of the business. Okay, so we get the strategy. Now let's dive into the hard data to see what really worked and what didn't this past quarter. This chart gives us the big picture. That 1% global growth was pretty much all driven by the international segment, which grew a solid 3%. Meanwhile, North America, their biggest and most mature market, came in flat at 0%. Now, 0 might not sound exciting, but for investors, after several quarters of declines, just steadying the ship is a huge win. And this brilliantly illustrates the two very different stories playing out in their most important markets. In the US, they got to flat by raising prices. That's the higher average ticket, even though they had a slight dip in foot traffic. China, on the other hand, is the total opposite. A spectacular 9% jump in transactions, meaning a ton of customers are coming in, but they're spending less each time. You know, this could be a deliberate strategy to claw that market share from intense local competition, prioritizing volume over margin for now. So here's the crucial nugget for investors. Even though the full quarter in the US was flat, the month of September alone was actually positive. This suggests that the new initiatives, like those customer service improvements, are starting to gain traction and build positive momentum heading into next year. It's a fundamental sign that the turnaround just might be working. But, like we said at the beginning, this comeback has a cost, and it is a massive cost. Let's flip to the other side of the coin, the direct hit to profitability. This number is just brutal, a contraction of 1,150 basis points in their operating margin. In plain English, that means Starbucks' ability to turn every dollar of sales into profit just collapsed compared to last year. This is the financial proof of the short-term pain they are willingly taking on. So where did this drop come from? Well, it wasn't mismanagement, it was deliberate choices. You've got the direct costs of rolling out the Back to Starbucks plan. You have the financial hit from closing 627 stores. And really importantly, you have a conscious investment in their people, more hours and better pay to improve service. All of that, plus inflation, explains the hit to their profits. And here's the bottom line for the shareholder. Earnings per share, the metric that sums it all up, fell from 80 cents last year to just 12 cents this quarter. That's an 85% drop. This is quite literally the cost of a new beginning. All right, so we've seen the present, early signs of growth, paid for by very low profitability. Now, what's next for investors? What's the plan to get out of this? The CFO, Rachel Ruggery, really puts things in perspective. She's telling the market loud and clear, be patient. This is not a quick fix. It's a multi-year turnaround. The message is that the focus is on sustainable, long-term growth, not some miraculous overnight recovery in profits. And the plan doesn't stop here. We're seeing a continued focus on innovation, service improvements, and some big marketing moves, like the new flagship store in Real Madrid Stadium and becoming the official coffee for the LA 28 Olympics. These aren't just headlines, they're investments designed to build the brand's value and lock in future growth. And that brings us to the final question this quarter poses to every single investor. Starbucks has hit the accelerator on its turnaround plan. It's managed to grow again, but it has massively sacrificed its profits to do so. The question hanging in the air is this: are we watching a smart, short-term investment that's going to pay off huge down the road? Or is the cost of this new beginning just too high? Time and the next few quarters will tell.